Our next presenter is Russ Colvin. Russ is presenting a self-storage deal in Las Vegas, Nevada. Russ, how are you doing this morning? How are you doing?
Very good. Very good.
Go ahead, Russ.
Good morning. My name is Russ Colvin. I'm CEO of YourSpace America Self-Storage. I appreciate everyone taking the time from their busy schedule today to participate in the presentation. I'd like to tell you a little about myself and the company and discuss track record because I think that's very important, and then present the Owens project, which is one of the most compelling self-storage investments I've been involved with in my career. I have spent my entire adult life in commercial real estate, 42 years, 22 years on the lending side, 20 years on the investment side. So I've never done anything else in my adult life except commercial real estate. We'll start with the track record and then go to Owens. I started investing and developing self-storage 11 years ago. I've had projects from California to New Jersey, Massachusetts, Texas, Missouri, Oregon, and currently projects in Las Vegas, Phoenix, and Tucson. All of the projects have been quite successful. IRRs have averaged around 31% at the project level, not including some of the recent projects in San Diego, New Jersey, and Las Vegas, with offers that would make that number much higher. Okay. I was CEO of North American Self-Storage for 5 years, and we had many successful projects. In the past 3 years, I've done projects with investors and now focus solely on YourSpace America. I have made a lot of money for investors in self-storage. We created YourSpace because I wanted to acquire and develop best-in-market, industry-leading projects and hold them long enough to realize their full financial potential. Holding them until they reach their financial potential is important, and we will discuss that today. I have a reputation for building high-quality projects, and I think you can take a look at the project here on the screen, and it doesn't really even look like self-storage. It looks like it could be an office building or a retail project, and that's really the goal. And as I said, I can answer any questions at the end of the deck. As I indicated, this first slide is a rendering of the project, which gives you a good idea overall for the project. Can we go to the next slide then? Disclosure, obviously this is important. Everybody should read the disclosure information. Next slide. Our purpose, clearly, as I mentioned, to develop industry-leading projects, best-in-class projects, best-in-market projects, projects that when they are eventually sold or disposed of, will reach the highest potential value, which achieves, the highest returns for our investors. Next slide. We have a great team from the management level to the acquisitions level, to relationships throughout the industry, and we'll discuss that as we move along here in the presentation. Next slide. Then the next slide. This slide is an overview. I won't take your time on this, but it's an overview of the company. It gives you an idea of our management team, our board of advisors, board of directors, but overall a great team at YourSpace. Next slide. Again, here another rendering of the project, executive summary. It's a 2.39 acre site located literally right on Interstate 15, above Interstate 15. The parcel itself is about 30 feet above Interstate 15. When the project is finished, it's going to have a 50-foot building height, so the signage at the top will be about 80 feet high. The city is also allowing us to install an 85-foot sign for the building, which would be about 115 feet above the highway. So it certainly will be one of the most recognizable self-storage projects in Las Vegas when it's completed. The traffic on Interstate 15 is around 175,000 cars a day. So, very high traffic area, huge visibility for the project. The traffic on Owens is about 15,000 a day. And as we go along here, we'll talk about the population numbers in the 3 and 5 mile radius, but very strong population. An undersupplied self-storage market, and I'll go through that in an upcoming slide. And of course, the growth story in Las Vegas is well known. A strong apartment market, probably one of the strongest in the entire country, low vacancy rate, increasing rents. The project itself is 158,783 square feet. Of that, about 116,255 will be actually net rentable area. The rest is taken up with hallways, corridors, loading areas, and all those things. Will be about 1,189 units, approximately 98 square feet average unit size. Next slide. As I mentioned, there are so many things about Las Vegas that make it attractive, that contribute to its growth. The best infrastructure in the country, a very attractive tax environment, a low tax environment, business friendly, the best restaurants in the world, entertainment, professional sports. As you know, the Raiders Stadium was completed not that long ago, and now the Oakland A's are moving to Las Vegas. So there's a reason all these people are moving to Las Vegas. Next slide. It's another slide rendering a little more of a close-up of the property. The building plans on this project are 100% complete. We own the property. It's going to be transferred to the OZ entity later this week. We're planning to pull our building permit before the end of the year. Okay, so it's essentially almost shovel ready. Next slide. As I mentioned, the project square footage, total project cost is about $23.158 million. Our rents are estimated to start out about $170. I actually think they will be higher than that, but we're taking a conservative approach and stabilized rents of about $2.29. Stabilized NOI of nearly $2.4 million, $2,393,000. The schedule below has our acquisition of the site into the OZ entity in October of 23, having our building permit in November, construction starting in November, construction ending 1 year later, November of 24, and full stabilization about 36 months after that. And down here you can see obviously construction financing of about 15 million and equity of about 8.1 million for the project. Next slide. We designed this project to be very pro-investor. Okay. We set it up with a 10% preferred return, an 80-20 split to a 15% return, and 70-30 thereafter. So investors should do very well. We're estimating that over a 10-year hold at the project level returns will be about 24.77 IRR and about a 4.21 multiple. But these numbers are actually better than that because we're planning to refinance around year 2 and return capital to investors. So assuming that investors then take that capital and reinvest it, their returns will be much higher than what we're potentially talking about here. Next slide. Again, discussing project start date, stabilization, and then of course the sale date we're assuming would be 10 years out. And I'll explain that in a few moments. We're assuming financing, average financing rate of about 6.8%. Assuming we pay higher interest given the current interest rate environment in the first 2 years. And then when we refinance at a lower rate, obviously, that will reduce the overall rate, for the hold period. We're acquiring this site for $2,440,000. We actually acquired it about a year ago, and we're basically passing on the site to our investors for our cost in the site. We have an appraisal just on the vacant site for $4.2 million. We're passing it on at the $2,440,000. So literally, investors literally make money from the time we close the site. Next slide. A few important areas here. Project has a clean environmental, no geotechnical issues. There's limited new supply coming to the market. That's the first thing we look at when we evaluate a self-storage project, is the existing supply and any potential new projects in the pipeline and how that would affect our project. And as I'm going to explain here in a few moments, it's a very positive message on this property in terms of supply. On construction, we use the top general contractor in the self-storage industry, Arco Murray. It's also the third largest design build firm in the United States. We believe it's critical that on any project that you have the very best possible general contractor and the very best possible third-party manager. We have a long relationship with Arco Murray and very confident in their abilities to get the job done and to get it done properly. The site is fully approved, fully entitled, which has been the case for over a year. We have full approvals from the Planning Commission, from the City Council. In fact, the city is very, very supportive of this project. And actually, when this project was approved, there were some city council members that wanted us to build similar projects in their areas. So, and I even have the city councilman for the area's office calling me to check on the project, how it's doing. So definitely support at the community level. Next slide. This slide gives you an idea. As you can see, the red dot is our project, the proximity to Interstate 15. It's, you know, very close to the highway, as you'll see. There are 174,000 people approximately within a 3 mile and 524,000 people within a 5 mile radius of this property, and in a supply challenged area. So this project will be the nicest self-storage facility in this market, in a market that has a shortage of self-storage, which is the ideal situation. I often tell people that we have to look at literally 50 sites to pick one that we think is ideal for self-storage. Most of everything that comes to us, we turn down. So finding one like this is rare. Next slide. This slide really reviews the existing supply and the development pipeline. There are no competitive properties in a 1 mile radius of this property. So once this project is completed, there'll still be a small shortage of storage in a 1 mile radius, which is unusual. In the 2 mile radius, there's limited supply. There's 3 projects, very undersupplied. So about 80,000 people in a 2 mile radius, and this many people should probably use about 650,000 square feet of self-storage. This area will be undersupplied when our project is finished by about 400,000 square feet. So the immediate area is undersupplied, the 2 miles undersupplied. The 3 mile radius is also undersupplied in terms of self-storage. There are 2 projects in the planning phase at the moment, but even after these projects are completed and our project is completed, there will still be a shortage of supply in the 3 mile radius in a growing area. Next slide. This next slide essentially illustrates the development pipeline in a 3 mile radius. You can see our property here in the red, and you see this circle. The circle is a 3 mile radius. Both of these 2 projects in the green, Charleston and Las Vegas, North Las Vegas, are over 2 miles from our property. But these are the projects that are in the pipeline. And as I said, even after all these projects are completed, there's still going to be a shortage of self-storage in this 3 mile radius here. Next slide. One more slide showing the proximity of our site to Interstate 15 and kind of an overview of where it's located within Las Vegas. Next slide. one more slide showing basically the vehicle per day counts for Interstate 15 and Owens Avenue. And again, this is a very strong illustration, if you will, of our project in the interstate highway. It'll be difficult to go north or south on Interstate 15 and not see this property. Next slide. This slide is a site plan of the property, which the colored area in the middle essentially is our property. Post-construction is the building itself. People will enter on Owens and they'll be able to drive all the way around and out. We'll have several loading areas for customers in the front, on the side, in the rear. So there's plenty of loading areas. I think very well designed. The office area will be in the front. It will be very, very attractive, not just in terms of the building itself, but the actual layout and how easy it will be for customers to access their units from these various points in the building. Next slide. This next slide talks about something that we talk about all the time internally that's critical, I believe, to a project. And this comes from, as I've said to people, from building a lot of projects and knowing what's important and making sure we have all these things in place in every project. General contractor selection, which I've touched on, using Arco Murray, having a fully adequately insured property for liability and everything else. We are sticklers for site security. So during the day when construction is ongoing at the property, we have the superintendent and everybody at the site. But after that, in the evenings or on the weekends, we have a security system designed to tell people to leave the site if they come onto the site. And if they don't leave the site within 2 minutes, it calls the police. But it keeps unwanted people off of our site in non-business hours. Online project monitoring. This is something we will make available to all of our investors. It's called the cluster system. And basically the superintendent on the projects takes photos every day of the project progress, posts them to the internet, to this site. And so we and our partners can go online and see what's happening virtually every day and look at the progress in the project. We have weekly project management calls to review construction progress and discuss any issues. Site safety, we're sticklers for that as well. Anybody that's visiting the site, we have a safety protocol. Project scheduling, we set up a schedule initially and we monitor it closely and we update it once a month. And by following all of these policies, the goal is to have a very smooth running project that's completed on schedule. Next slide. This next slide touches on contract third-party management. As I mentioned, we use Arco Murray, and we also use public REIT management, which is either Public Storage, CubeSmart, or Extra Space. You can see from the renderings that we have Extra Space was our initial potential third-party manager, but Public Storage also very much wants to manage this project. The advantage to having third-party management is that, for example, in the Las Vegas market, each of these companies has a major presence in the market. They each have like 20 or more self-storage projects in the market. And that's actually good for our project to the extent that customers need units and they don't have it available at other projects, they can send them to our site. The quality of their reporting is excellent. They're public companies. They put out very high quality monthly reporting. We virtually get a daily report on leasing, which basically shows how many people moved in, how many people moved out, what is the actual occupancy level. what are the actual rents collected per month? What is the current rent per square foot that we're collecting? All of these things we can manage very carefully. And of course, we have strong asset management as well. So no matter who your third-party manager is, we manage them as well. But it's critical, I believe, to make sure you have the right contractor and the right manager on a project, in addition to having all the other things like the location, the competition, all those things that make it successful. Next slide. This next slide is about the disposition or ultimate sale of the property. This assumes 10 years out selling the property. This NOI comes from a pro forma that was actually created by the Extra Space people. And our pro forma is actually very similar. But basically, it shows that in year 10, we're going to have approximately nearly a 2.4 million NOI. We would sell at about a 4 cap rate. We'd obviously sell at the time we thought, market conditions were ideal, which is almost a $60 million sales price. So if you look at the total cost on the project, in the $23 million range, and you look at what we're planning to sell it for in 10 years, it obviously has the makings of an extremely successful project. Next slide. These next 2 pages are the 10-year pro forma, starting with year 1, going all the way out to year 10. Basically has the annual income and expense projections for the project. And I think these are pretty conservative. One thing that I think is really not reflected here is having the best product in a market that's terribly undersupplied. I think will give us some more leeway in terms of achieving higher rates, but we have used more conservative rates here. We would rather use conservative rates and then surprise our partners in terms of what we're collecting. Next slide. This next slide is a 10-year projection, if you will, on the returns for the property, 24.77 IRR to investors, a 4.21 multiple. If you look at this, it has 3 different investment amounts, 100,000, 250, and $1 million. And basically what it shows is that investors are receiving return of their capital in year 2. Okay, so after the end of year 2, investors don't have anything invested, but they will continue to receive tax benefits and cash flow from the property. And then at the eventual sale, the sale indicates, along with the cash flow, that people getting about 3 times what their original investment was as a profit. Okay. So if you invest $1 million, you end up getting your capital back plus about 3.2 million. So over a 10-year period, there are very few real estate investments that achieve that. And clearly in the market, self-storage is a top performer, has been a top performer. It's been the top performing property in the NAREIT index since 1994 on average. So for the last 29 years, self-storage has outperformed every other property type, from industrial to office to multifamily, you name it. And then down towards the bottom, it shows the tax benefits with depreciation. Okay, this is an estimate. I think the depreciation will actually be a little more because we're going to use a little more accelerated depreciation here, but the tax benefits are very compelling. You can see the totals there. And the annual depreciation is pretty compelling as well. You can see those numbers. On $1 million investment, it's $73,000 a year. So your income from this investment is essentially completely tax sheltered. And on an opportunity zone project, there is no recapture of depreciation. So when you sell the property, that's another major tax benefit as well. So when you analyze this entire property in terms of, its tax benefits, the overall property itself in terms of market conditions, it's extremely compelling. As I said, of all the self-storage projects I've been involved in over the years, this is certainly at the very top of the list, up there with top couple of projects. You can tell I'm obviously a big believer in this project, and I hope that many of you will join us in this project. So with that, I'll answer any questions anybody may have.
No, fantastic, Russ. I'll just hit through the next couple of slides here. Did you want to go over the investment returns here briefly?
Yeah, I just kind of covered that.
Okay.
Essentially, just for round numbers, if you invest $1 million, you'll be getting your money back in year 2, but your returns based on that investment, you'll be making about $3 million, $3.2 million in 10 years, over 10 years. Okay.
Very good.
So, I mean, as I say, it's hard to replicate that in any other kind of real estate that achieves such great returns, but is also extremely safe, you know?
Yeah. Like you mentioned, the top performing sector according to Nareit over the last 29 years, self-storage. Yes. This one has a lot of tailwinds, the demographic tailwinds of Las Vegas, the location, site selection. Looks like a great project. Russ, I've got your phone number and your email address listed on this final slide here.
Oh, very good. Okay.
And then let's get to some questions. We've got about 6 or 7 minutes before we have to turn to our next presenter. By the way, first of all, you did mention briefly that an OZ entity is going to take over this. So is this an opportunity zone deal? Yes. And can you give a quick recap of some of the tax benefits available to LPs if they do come in as an opportunity zone equity investor?
Obviously, if they come in as an opportunity zone investor, and by the way, if anybody on this call has questions regarding opportunity zone tax questions or anything like that, if it's helpful to you, we can certainly get our counsel, Brett Siglin at Fenimore, who's an expert on this, and have him talk to you, okay? But in a nutshell, essentially on a 10-year hold, if you stay in the project for the 10 years, your gains on the project are not taxable. There is no depreciation recapture. The income is completely sheltered. So essentially, whatever you're making out of this project, there's no tax on it. So the $3.2 million somebody would make on a $1 million investment, there isn't any tax on it.
Yeah, it's
so I mean, it's pretty compelling on that from that perspective.
For those who may not be aware of me and my other platform, Opportunity DB, I've frequently referred to opportunity zone investing as the greatest tax incentive ever created. We have an entire event focused on opportunity zone investing next month at Opportunity DB. You can learn more at ozpitchday.com if you like today's events, which are focused broadly on the entire alternative investment universe. Our event on November 9th, ozpitchday.com, will be focused just on these types of opportunity zone investments, highly tax advantageous. A couple questions here from Brett I want to get to. One, he asks, how do you fill the funding gap if your LP raise is short? Have you ever run into problems with the LP raise being short, Russ?
No. I mean, I think this is a great project. There's a lot of interest in it. We already have people that are coming into it. I think, within the next 60 to 90 days, it'll be completely filled. Never had a problem raising capital for a project.
You've been doing this a long time too. So as you mentioned, so next question from Kevin here. When you mention, Russ, that there's a shortage of self-storage near this project, does that translate into high occupancy and ensure charging market rates without concessions?
Well, yeah, I mean, that's a great question. I mean, what it means is, obviously, as I say, that's the first thing we look at in evaluating any project. We don't want to be in an oversupplied market. We want to be in an undersupplied market. The reasons for that are obvious. But I would think in this project, we should have to make very few concessions in terms of lease up. And hopefully we're pleasantly surprised in terms of the kind of rates we can achieve that will hopefully be better than what we're projecting.
Excellent. Andy asks, you mentioned that you pass on 50 sites for every one site that you pick. What about this site makes it ideal for self-storage? If you can review that again for Andy.
It's one of those that seems to have, all the right things. the location, obviously I've mentioned the Interstate 15, the supply dynamics in the market, which are unusual, by the way, to have such a positive, supply demand picture for a project. I think there's a real demand. In addition to all of that, just being, I think, in the Las Vegas market, you're building a project in a market that's undergoing very solid growth. I think they're planning on the population growing 9% in the next 3 years. It's just a great market in terms of growth. And I think that just translates into a successful project.
Good. We got time for 2 or 3 more questions here. This one comes in asking a question about the overall self-storage sector now, Russ. Do you think the sector is overheated potentially? Is there a risk there could be oversupply in the next, say, 3 to 5 years?
Well, oversupply is a good question. And as I'm talking about, that's the first thing we look at. We don't want to be in a market that's oversupplied. But if you look at the performance of self-storage, look at the Great Recession, okay? It was the top performing product then as well. It had the lowest delinquency rate of any property type, very low delinquency rate. During the pandemic, it performed well. It seems to perform well. People have called it recession proof. I would call it recession resistant. It seems to perform well in up and down markets. Some people have called it a foolproof property type. That's not quite true. But again, if you follow all the basic measures, if you will, in terms of supply, demand, location, all of those, very basic things about self-storage development, as I say, this property is a great example of why it should be successful.
Excellent. Let's see, a couple more questions here. If someone's interested in investing, is this offering closing soon? How long do you anticipate it will remain open for new investment?
I would think it should be around for another 60 to 90 days. Okay.
So about through toward the end of the year, but don't wait too long if you want to jump on this one. What about 1031? Can you do a 1031 with this deal? You
can't really do a 1031 here, unfortunately, because you'd have to essentially be a DST or a TIC or one of those. You can't really do that with a partnership interest, unfortunately. But we are going to be having some projects in the future that are designed for exchanges. But this one is not.
Okay, maybe you'll have to present one of those DST products next year with us.
I'd like to have one like this for exchange investors.
Good. Last question here comes from Remy. Remy asks, so with OZ, are all the returns tax-free? A second part to the question, can we use IRA money?
If you qualify, if the funds you're investing qualify for an opportunity zone investment, if you're redeploying a gain from somewhere, then you get all the benefits. But let's assume it's not an opportunity zone investment. Let's just assume you want to write a check for $1 million and invest in the project, or 100,000 or 50,000 or whatever. Okay. If you look at the overall returns, the return of capital in year 2, the tax benefits, all of those things, it's extremely compelling. There will be some tax. But essentially, your cash flow during the term of ownership is completely sheltered. In fact, you should have more shelter than you're having income from the property, so it should help you in other areas as well. I'd be happy to discuss that in more detail with anybody offline that would like to talk about it. But the tax benefits here will exceed the cash flow from the property. So it's compelling whether you're an OZ opportunity or zone investor or not.
All right, we're going to sneak in one more question before we move on to our next presentation. Russ, what is the minimum investment amount for this deal?
$50,000.
$50,000. All right, fairly low as far as these things go sometimes. So Russ, great presentation. This is one of many self-storage facilities that you've built over the course of your career and that you're raising capital for right now. Thank you for bringing this opportunity to our audience today at Alts Expo. Really appreciate your time. And
Thank you. Thank
we're
you,
gonna
everybody, for your time. I know
and we'll
everybody
see you
on the
next
call is
month
busy.
at OZ Pitch Day to talk
Okay.
more about this deal and maybe one or two of your other deals as well. We'll see what happens.
Yes.
All
Thank
right.
you. Take care.
Awesome. Thank you, Russ. Really appreciate your time.